Welcome to another video of OptaTube. Today, we are going to pull back the curtain on the absolutely fascinating, incredibly complex, and, let's be honest, often volatile world of electricity markets. We're going to demystify how the price of the power you use every single day is set, literally moment by moment. So let's just start with the big question right off the bat. At the end of the day, electricity is a product, right? You need it, you buy it. But have you ever stopped to wonder why its price can swing so wildly? I mean, it's not like the price of milk suddenly doubling on a Tuesday afternoon. What makes electricity so different? Well, that is the central puzzle we are going to solve together today. You see, the reason for all that complexity comes down to a few really unique quirks. First off, unlike oil or grain, you can't just fill up a giant warehouse with electricity for a rainy day. It has to be made and used in almost the exact same instant. Second, it doesn't just go where you want it to. It follows the laws of physics across the grid, which can create some serious traffic jams. Third, its quality, things like frequency and voltage, has to be perfect, or gadgets just won't work. And finally, its supply can be all over the place, especially now with renewables that rely on the weather. So, to make sense of all this, here's our game plan. We'll start by digging into why electricity is just such a tricky commodity. Then we'll hit the basics, supply and demand. After that, we'll actually build our own virtual power supply, run a quick simulation to see it in action, and finally, we'll look at how the pros try to predict those wild price storms. So let's kick things off with that core challenge. You have to remember, the entire grid is one giant, non-stop balancing act. Every second of every day, the amount of power being generated has to perfectly, and I mean perfectly, match what's being used. It's this need for perfect, instantaneous balance that makes this market unlike any other. All right, so how in the world does the market achieve that perfect balance? Well, it all boils down to the most fundamental rule in all of economics, that magical point where supply meets demand. This is where the price is born. You can really think of it as a conversation. On one side of the chat, you've got all the power plants, ready and willing to generate electricity. That's our supply. And on the other side, you've got all of us, our homes, our factories, our businesses, ready to use that power. That's our demand. The price gets set at the exact spot where those two forces meet in the middle. It's called the market clearing price, or MCP. It's that sweet spot where the amount of power suppliers are willing to sell perfectly matches what we consumers want to buy. At that price, for that moment, the market clears. So what does that look like in the real world? Well, for any given hour, the market might clear at, say, 85.70 euros per megawatt hour. Now, that number isn't just pulled out of a hat. It's the precise result of that supply and demand handshake. It's the price that everyone, both buyers and sellers, deals with for that specific block of time. Okay, so we've seen theory, the nice, clean curves. But where does that supply curve actually come from? Let's get out of the textbook and into the real world by looking at the actual power plants that make up the supply side of things. The whole thing is organized by a really elegant and efficient system called the merit order. Basically, it's a ranking of every single available power plant, from the cheapest to run all the way to the most expensive. And the golden rule is simple. You always use the cheapest stuff first. And this is where it gets really cool. Think of this table as the team roster for the grid operator. It's all sorted by marginal cost, which is just a fancy way of saying how much does it cost to make one more unit of power. Right at the bottom of the cost stack, you've got solar and wind with a marginal cost of 0 because their fuel, the sun and wind, is free, so they're always the first draft picks. Then you move up the cost ladder. Nuclear, hydro, coal, and on, all the way to those super expensive peaking plants the only call on in an emergency. All right, we've got our team roster all lined up according to the merit order. Now for the fun part. Let's actually put this system into action. We're going to run a little dispatch simulation to see exactly how the grid decides who gets the call to generate power at any given moment. The logic here is actually pretty straightforward. First, the system figures out the total demand for the hour. Second, it starts calling up generators from our merit order list, starting with the cheapest, of course. And third, it just keeps adding more and more generators to the mix until the total amount of power being produced perfectly matches the demand. So let's run the numbers. Let's say demand is 280 megawatts. The system first grabs all the free stuff it can get, say 48 megawatts from solar and 40 from wind. That gets us to 88 megawatts. Not even close. So it goes to the next cheapest on the list, nuclear, for another 100 megawatts. Okay, now we're at 188. Still short. Next up is hydro. That gives us another 40. We're at 228 now.
To perfectly hit our 280 target, we need exactly 52 megawatts from the coal plant. And boom, we're balanced.
And this brings us to what is easily the most important and maybe most surprising concept in this whole explainer. The crucial point is this. The price of that last, most expensive power plant we had to turn on, in our example, the coal plant, that price sets the market price for everybody. That's right. Even though the solar and wind power cost nothing to make, they get paid the exact same high price as that final most expensive generator. Okay, so now we get how the price is set in a single snapshot in time. But what makes it so darn volatile over hours, days, and weeks? Well, a massive piece of that puzzle is the uncertainty that comes along with renewables. You know, on a calm, boring day where everything goes as planned, prices are pretty stable. But on a volatile day, anything can happen. A heat wave can cause demand to spike. A big power plant could suddenly trip and go offline. Or a huge bank of clouds could just roll over a massive solar farm. Any one of these things can force the grid operator to fire up those super expensive peaking plants we talked about, and that's when you see prices go through the roof. So how do energy traders and planners even begin to deal with this level of chaos? They use incredibly powerful tools, like a Monte Carlo simulation. Just think of it like a super-powered weather forecast, but for prices. Instead of running one single prediction, it runs thousands, even millions of possible futures. What if it's really windy? What if there's a heat wave? What if a plant breaks? It does this to map out the entire range of possibilities and see the real risks of extreme prices. And when we run one of these simulations, this is what we get. That solid line right down the middle, that's the average, the most likely price path. But the dotted lines, that's where the real story is. The top line is the 95th percentile, a pretty bad, high-priced world. The bottom line is the 5th percentile, a really cheap power scenario. And just look at how that cone of uncertainty gets wider and wider the further out you try to predict. And this right here is where it gets real. Our simulation might show a normal average price 30 days from now, but that 95th percentile path shows us there's a real quantifiable chance that the price could spike to something like 185.5 euros per megawatt hour. That is the price storm, the volatility we talked about right at the very beginning. And this is what everyone in the market has to prepare for. Now, it's really important to note that this real-time or spot market we've been focused on is just one piece of a much larger puzzle. To handle all that risk and volatility, the industry uses a bunch of other markets too. There are day-ahead markets for planning tomorrow's grid, intraday markets for making last-minute adjustments, and even futures markets for locking in prices months or years down the road. They're all tools for taming that uncertainty. So, from the simple handshake of supply and demand to the merit order stack and complex forecasting simulations, we've really pieced together the puzzle of how electricity prices are set. If you are interested in energy market and power system modeling and you want more updates and insights about the global energy market, make sure to follow the OptaTube channel. And all of this leads us to one final massive thought to leave you with. We've seen how the system is designed to use the cheapest power first, which is great for renewables. But we've also seen how their unpredictable nature can cause huge price swings. So the big question for the future is this. As our grid leans more and more on weather-dependent energy, how will our markets themselves need to change to make sure we get the best of both worlds? Low prices and a grid that never fails. That's the billion-dollar question for the future of our energy system.